All right, hello and welcome everyone to FOMC Thursday, the big day we've been waiting for. Just ahead of the start here, guys, real quick, we do get the housing starts out of the United States with building permits also on tap in just about 15 seconds. Good morning, Eileen, Gary, Graham. Great to see you guys in the room. Cameron's back. Kyle, Mark, Mario. I didn't get to your questions yesterday, so please remind me if I don't. Okay. Housing starts come in slightly better than expected, negative 0.3%, negative 3%. We were looking for negative 3.8 in the housing starts. Building permits, the slight increase, 3.5%. Nice healthy print for August, above the 2.5 expectations. No major downward revisions except for the housing starts. Last month actually saw a decrease of 4.1%, and that was off a previous read of 0.2. Unlikely that you'll get any data or any announcements or even rhetoric today really moving markets in any particular direction ahead of this afternoon's interest rate decision. You're looking at the dollar index here holding steady on the back of that print. Not much of an initial reaction. Mario, great to see you, man. Thank you for that. All right, so we have a lot to cover. If you noticed yesterday's intraday update, certainly had quite a plethora of setups here. So I just wanted to kind of highlight all the dollar setups as we came into today between the intraday chart update and the actual intraday page where we had the Kiwi and the yen. We've sort of covered all our bases as far as what we should be looking for the dollar. Look, at the end of the day, if we look at consensus estimates, recent bank research we've been thumbing through, it's pretty split, and that's when the risk of a real surge in volatility really surmounts even more so. Okay, typically we go into these releases saying the risk is that they do raise or the risk is that they don't raise, and we'll know based on what they do, what the divergence with expectation was, and we kind of have a game plan. When you're coming into a release like this, where 54% of economists surveyed said that they would hold today. Literally, out of like 113, I think 54 are on the side of a hold today. So what that suggests is, again, there's a slight risk. The risk is if they do hike, for the market to show reactions. We've continued to see the consensus drop. Remember, when we were, way back in May and April, everyone was talking about the June rate hike and how that was going to be, in the cards for the Fed. The June meeting came up. They kind of got cold feet. They said, we're ready. Things are still on pace, but we still want to see. Everything got kicked back to September. In fact, last month, if you look at some of the estimates, some of them were calling for a 70% or an 80% even on some bank wires chance for an interest rate hike today. And the market was pricing that in. Now that we're sort of taking a step back, we got that huge spillover in equity markets, last month. Things have changed, and you've seen those expectations continue to drop. So now with this sort of split consensus where half the market is expecting, or a slight majority is leaning towards, let's say, that they're going to hold rates today, and then the other half saying that they're going to raise rates today, two possible scenarios. The risk is slightly leaning towards the fact if they do raise, okay, for some sort of more meaningful market reaction, or if they come out with a more non-conventional approach. And this is something we noted a couple of times in the webinar this week, so I don't want to harp on it. But if they do come out with some sort of lower magnitude increase in the nominal rate, so whether it's a 10 basis point or 12.5, there was actually one bank research, it's the first time I actually saw it yesterday, that suggested maybe they would do a 12.5 basis point hike just to get the process started. They've achieved liftoff. They've remained committed to their suggestion to the market earlier in the year that they're going to see a raise in the rate for 2015. If they don't do it today, guys, it's hard to see them raising rates on a meeting where we don't have the presser with Janet and the projections. You'd think with a major move to lift rates for the first time in over 8 years that, they would want to do that on a meeting that has a presser and that also has the subsequent projections from all the committee. So today we also get the projections as it pertains to growth, inflation, interest rates, and the dot plot, which is so highly toted around as sort of the more what's the word I'm looking for? The more transparent modes that the Fed has to communicate. So we'll see. We'll be paying attention to all those things. At the end of the day, if they do see a drop or if we do see a downward revision in growth prospects, particularly inflation, you're likely to see a little bit more weakness in the dollar. And that's only going to exacerbate what we've seen. So keep your seatbelts fastened. It's going to get exciting as we head into the 2 o'clock hour. We'll get the release, which is going to have the projections, which is going to have the fact of whether they raised or not, and that's what's going to be the initial market impact. Remember, over the last, I don't want to say, I guess it's 6 years since they last hiked, or since we've been at this level, we've seen not really much of a market reaction on the 2 o'clock print because we've known that they're going to hold rates. And really the move for the FOMC for the last 5.5 years has been the subsequent presser, as the Q&A is really telling. People start to press her, she slips up, or she starts to say, oh, okay, well, this is what we're really expecting. And we really get a little bit more insight on where the Fed sits. This is the first time in years and years and years where the actual 2 o'clock release may prompt will prompt some market volatility. If they decide to hike and we get that hike, I'm not really going to be looking to necessarily short the dollar, but I would look to see if that rally, subsequent rally on an interest rate hike, would give us a better opportunity for entry. If they do decide to hold, you might not see the dollar react right off the bat. We'll have to see what the presser says, and if the presser suggests, like I said, that this is just the first of the liftoff, or if they're more concerned about global concerns, then we'll see. Then we'll see what the reaction will be. You mean 7 p.m. London time? Raj is asking. Yeah, I'm not sure what it translates to. It's the 2 p.m. here in New York is going to be the print, and then 2:30 in New York is going to be when the presser starts. So from a trading standpoint, let's jump into the charts. So really quick, just a quick note of caution. On these types of prints, guys, I tried to give you a quick heads up yesterday, just on my thoughts, the way I trade these. You want to just reduce your leverage. It's a smart thing to do when you're coming into a major event risk like this. You're going to see larger swings in volatility, and you just want to make sure that you're keeping yourself on the safer side of things. Let me restate that, guys. Risk management is paramount in situations like today. So that's all I want to say. Make sure that we're being a little bit more prudent. I wouldn't stress momentum triggers. We'll go over that in a moment, because you're likely to get real whipsaw action. So price action is really what the focal point should be around all the entries for today's scalps. Andrew says, hike but imply one and done. Initial dollar spike followed by reversal. Andrew, if that's the signal they send today, I would 100% agree with that would probably be my game plan. Yellen has postulated to us multiple times already, guys, that it's not the timing of the first interest rate hike that matters, but the pace. So I'm completely on board with you, Andrew. If she comes out and says, look, we're just going to raise it today, but there's nothing on the horizon, things are kind of a little iffy abroad. Domestically, we remain strong, although the data has been lackluster. It's hard, guys, really hard from both ends. How are you going to say that we're looking for maximum employment and inflation when employment's at 5.2%? That's a normal running rate of unemployment, but we have abnormal monetary policy at 0% still. And on the flip side of that, well, if the dual mandate is as such, then how can you look to raise interest rates when inflation still remains lackluster? So Andrew, 100%. It's all about the pace and the time. The first timing has been what the markets are stressing now because we haven't gotten one in 8 years, right? But after that, it's going to be all about the wording and the language and whether this is going to be ongoing. Also keep in mind, guys, that historically speaking, there has never been an interest rate hike on an election year. So what that means is that essentially leaves October and December, next two meetings, for them to possibly, is it October? I'm not even sure actually if it's October. Well, this is actually pretty interesting too. Here's the median estimate of what people are expecting for a 25 basis point hike. This is a little bit more dated, but it really suggests how split we are on whether they hike hike a lot or don't hike at all. So we'll be looking for the market reaction right on the back of that. But long story short, guys, there's never been a hike during an election year, and you'll continue to hear that from people. If they don't raise today, I don't really see how, they can stay on hold until 2017. I mean, that would be insane. So it's going to put a lot of strain on what happens today. All right. Dan says, Raj, I got your question there. Sterling Oz, I'm going to jot it down. Yeah, if I don't get there, remind me, okay? We got a lot to go over today. Dan says, great advice for new traders, Michael. Over leverage and front running these events are not smart. I learned before when shorted sterling Kiwi and Kiwi cut rates. You can imagine how that worked out. LOL. Yeah, I hear you, Dan. And again, experience is master, is the best teacher there is. So over the years, I've been there, done that. And the worst thing that can happen is that you have a good experience doing one of those more cavalier type of trade strategies, because you go into the next one with a little bit more confidence when, maybe it was just luck. But in any event, guys, risk tolerance or risk management rather, is going to be paramount today. All right, so I want to jump right into the charts real quick. Here's the relative performance on the greenback as we head into the U.S. Open. Kind of mixed performance. You saw that the Aussie's down 0.49%. We'll take a look at that. It was on yesterday's scalp chart. That's testing near-term median line support. Kiwi dollar also has a very clean range. We were at resistance last night. We noted that on the radar charts. That started to come off a little bit, and we're down 0.42%. Pretty lackluster on CAD and pound. Swissy, not really going to stress, but the euro up 0.33%. We continue to favor the long side of the euro, guys. Again, we've made a nice little push back into the highs here. Wouldn't want to do anything, obviously, ahead of the FOMC, but on a pullback into support, on a break of resistance, really would validate that near-term long bias. We'd look for some possible long entries. So let's jump into the charts. Before we start jumping into the crosses, real quick look at the dollar index. Here's what the daily looks like. Again, if you're on Daily FX, guys, on the intraday page on the bottom right-hand corner, you can see all the research that comes out on Daily FX as well. I put out a piece there for them every day. It's a little bit more of a broader piece, but this was the chart that we highlighted yesterday. We were coming right into near-term support with the lower median line parallel extending off of those, I guess it was the April-May lows. So we're kind of sitting there right now. Support 11,942. There's also an extension that confluences that region. I'll show you in the intraday. But long story short, momentum has continued to hold 60 on the last 4 attempts to break off the yearly high. Here's the April high for the year. 60 hold, 40 break. 60 hold, not seeing much of a 40 break, but you're seeing 60 hold on every rally. So the broader trend still remains, or the broader uptrend still remains at risk. We really haven't gotten that deep break into oversold. Secondly, as long as we're in the confines of these formations, you have an embedded one and the broader one off the yearly high. Your initial bearish invalidation level is the monthly open, which coincides with the upper median line parallel at 12,028. And what would put us bullish again would be a break above 12,050, which is this confluence region, sliding parallel, and the broader structure off the highs. So the levels of invalidation or resistance rather are pretty clear. Support on the downside, 11,942. Beyond that, you'll look for that 100-day moving average, comes in at 11,930. And finally, the key 618 comes in at right above the 900 handle. And again, I'll show you the intraday chart. There's some serious support there as well. A quick reminder for anyone who's new to the room here, at any point during the webinars, guys, there's a camera button right here on the top right-hand corner of your GoToWebinar screen. You can always click on that to take a freeze frame of any of the charts that you see presented on SB. So if you need to reference them during the day while you're trading, feel free to do that. All right, so seeing where we are sort of with the dollar, it's been, if you constitute this as a break of the weekly, or the monthly rather, opening range low, which I'm not really inclined to do so much yet, just because we kind of didn't see the break in the run. It's been dilly-dallying here for a couple of days. If this is or it constitutes a break of the opening range low for the month, either way, the monthly open would be the invalidation level. So, we're looking to sell rallies. If they raise rates, market has been pricing in, remember earlier in the year, has been pricing in interest rate hike this year. So we could see a rally that would offer a nice position for some short scalps. You're probably not going to catch the initial move, okay, because it's market might even gap, guys. There's so much split decision on what they're going to do. And once we get whether they hike or not, the bottom line, the black and white, you might not catch that initial move. So if it offers a rally for the dollar, we'll be looking for resistance at those levels. If it offers an initial instant break, don't chase that, okay? Look for the rebound, a quick recovery in price to get back in. And that's how we'll treat these scalps. Nimble is the name of the game, lighter on leverage, and quicker to peel some off and pull your stop in. Raj says, hopefully this mayhem won't affect the EURUSD long trade. From the swing side of things you're talking about, Raj. Yeah, most of the crosses, they'll see some volatility really intraday on the tighter terms, but nothing I think that would necessarily affect the larger scale trades that at least not in the crosses, Raj. All right, so this is the dollar on the daily chart. Here's what it looks like intraday before we move on to the euro crosses, or to the other dollar crosses. You can see that we're holding really nicely within the confines of just a basic descending channel formation off the high. 3 tags of resistance really solidifies this. 3 tags of support really solidifies that. And the levels are pretty clear. The invalidation level for the immediate downside bias, meaning if we get through FOMC and we come right into this level, first level of resistance is 11,980 into 11,989, 11,989 being or representing the weekly open. So you got trendline resistance there off the highs. You got the 100% extension off the highs. Nice area of resistance here as we head into FOMC. Support, let me just snap these pitchfork real quick. Even more so, actually, let me just go back 1 second, is that former lower median line parallel. This comes in right in that same level. Okay, so the levels are pretty clear. It's going to be the immediate bearish invalidation. September open is going to be the broader bearish invalidation here, and then this would put us on the long side for the trade. Kind of want to stay neutral if we get into this range here. On the support side of things, again, 11,942, as we suggested here, the 50%. Just beyond that is the 1618 extension off the high. Okay, so nice area of support. You also have the just basic channel support off the high that comes just below that region, and this will be near-term support for the dollar or a target on the shorts. A break below that, it really opens up 11,960. There's just or 906 rather. There's nothing until that 618. Soft target at that 100-day moving average, but look for that 618 down at 11,906. So, although we can't necessarily trade the dollar index here on the state side, as I always say, it's a great way to be able to ascertain just broader dollar movements. At its inception, it was an equally weighted average with the euro, Aussie, sterling, and yen. So really the most liquid, most traded currencies against the greenback. Clear levels for the greenback. Broadly looking lower, sub 11,890, or excuse me, 11,989. Looking for shorts below this region. And again, monthly open will invalidate this. Any questions on the dollar before we move on? Okay, we got to start moving quick. Let's go through the majors. And here's what we look like from yesterday's setup. So first thing was dollar CAD. I was just kind of thumbing through the dollar charts, guys, so there's no necessary order to the trades on the swing setup here, but here's what it looked like on yesterday's FOMC update for dollar CAD. So dollar CAD, we highlighted this chart on the radar charts earlier in the week, and the only thing that we were just focused on was 132.88. That was the reversal day close for the August rally. That was the invalidation level for the short bias, and 133.35 is what would put us constructive again, the high day close. So heading into trade yesterday, or heading right after the webinar ended, actually, you saw a more valid break of the weekly opening range. Cameron, I know you're new to the room. We were talking about this yesterday here. This exemplified probably the cleanest opening range break this week. So here's your Sunday open. You set a low in Sunday, you test it. Monday high, you test the lows. The range is set. Wednesday break, you're looking lower, sub 32.25. but broadly speaking, the invalidation level is still at that reversal day close. We do have that median line off the high for $CAD, which has been in play, but kind of probed through it a couple times, so I don't want to stress it too much. So as long as we stay within this, we're looking to sell broader rallies. Today's print is likely to offer something, because if we plow through this, forget it. It's right back on the continuation. You're looking for a rally into that key 618 up at 134.60. But barring that, or a really positive dollar reaction, you're still looking for a drop into 131.38, which is the monthly open. And then confluence support just a little bit lower, 130.60, 130.50 there. Here's what it looks like on the intraday today. And here's what we looked like last night. All right, so you had a soft target at 131.70. It's the same levels, guys, from the radar chart on, I think it was on Tuesday. So there's no change. Actually, I think I linked it for you. Yeah. Oh, it was on the 8th of last week. So the same levels from that report haven't changed. This is what we look like back on the 5th into the 8th, 32.88, and their soft support at 31.70. We're sitting right there right now. All right, so could get a little bit more of an upswing. Look for some near-term resistance at 32.25, the upper median line parallel. And again, if we break 32.88, which is not only the reversal day close, but also the objective weekly opening range high, that would invalidate our idea to sell rallies here in $CAD. Cameron, I don't know that there is, my man. He says, I missed the midweek strategy webinar, and is there any way to watch it from YouTube because it's blocked in the country I live in? No, there's not any way that I know of. They're actually just all archived on GoToWebinar or YouTube. Cameron, that's interesting because we have it embedded on the page. You're still having problems seeing it? All right, keep me updated on that. Mark, great to see you in the room. He says, just joined, wanted to ask, is there any actual consensus on what the dollar will do, rate, no rate cut? So Mark, we did go over that at length in the morning, so I don't want to start it from scratch, but the only thing I can tell you is that it's slightly leaning towards no lift. I think out of 100, and I read it, 113, 54 correspondents said that they were looking for them to hold. So it's really split, but it's a slight lean towards a hold today. Cameron says, I can't see it on the page. I think it's a YouTube page. Yeah, it's a YouTube embedded link is what it is, Cameron. Let me think about that for a bit. I'll talk to the developers, see if we can come up with something for you. So $CAD levels are mapped out pretty well. Favoring the downside, I'd favor selling rallies. We have a clear invalidation level. Downside levels are pretty clear as well. 31.38 monthly open, 31.04, 618, and then down into 30.60. All right, that is $CAD. Next up on tap on yesterday's scalp setups was the Aussie dollar. Not really a setup, okay? And I don't want to stress this setup as much, but the levels are clear, and there's no point not to look at it. We basically ran into the initial first level of key resistance here for Aussie dollar. By the way, that trend line that you're looking at there extends off the lows that you made in 2001, the 2008 low, and that's the one that we broke through earlier last month, and here we are right back above it. First hurdle of resistance, a basic 236 off the high, nothing special. And right back above that key 618 retracement, that's the 618 off the 2001 lows. We pivoted off it and broke, really gave us the downside drop last month. Here is resistance. Momentum at 50. So the risk here, and this is something I just wanted to highlight, is if we do get a sell-off in the dollar, Aussie's at resistance, man. This thing plows through 72. You're basically looking for a 100 pip rally towards the 73 handle. And that level coincides with that sliding parallel. A nice pivot in price there. So look to see if we do get some dollar weakness, this would be a favored play. Specifically on this, you also have a trigger on the daily, right? So if we plow through 50, that would be the first break above 50 since, what is that, April, right? And that led into a nice rally. So if we break 50 on the upside in momentum, we plow through 72, we'll look to buy rallies for 100 pips up towards that 73 handle. On the downside, if you do see dollar, if we do see, this is the opposite. If the dollar weakens, guys, that's what we're looking for. If we do see dollar strength, this is not going to be the favored play. Okay, dollar strength, I'd rather play that versus possibly the yen, which is pulled back a little bit, which is starting to look like it wants to break resistance. Maybe the sterling, which is coming into a phenomenal area of resistance. This would be the favored move. Excuse me, guys, I misspoke earlier. This would be the favored move for extreme dollar weakness. If Aussie plows through 72, it would be a nice breakout, in my opinion. Remember, objectively, this is a break of the monthly opening range. So the monthly opening range high came in at 71.50. So especially if we spike down in 71.50, if we hold, we plow through the upside to get that momentum break, looks like a good play. On the intraday, it's basically holding this formation for the last 2 weeks. There's not much near-term targets. The ATR has been contracting. It's only 25 pips at this point, but could offer some guidance. So again, further highlighting the near-term resistance we just came into. Remember that 236 off the highs? It's also an exact 1618 extension off the low. So near-term targets on a topside breach, you'd be looking for 72.65. You'd be looking for 73. And as I said, that's going to be a nice confluence there with a sliding parallel dating all the way back to March, April. Hussein, how's it going? Great to see you in the room, sir. So Aussie, haven't played it for a while. I've wanted to. I like where we're sitting on dollar weakness. Aussie strength, a breakthrough, 72, 72.08. Looks to target those subsequent topside objectives. If we do get dollar strength, Aussie weakness, not really looking to play it through Aussie dollar. All right, next up on tap is sterling. Another one, phenomenal area of resistance. We've talked about this region for a while. If you guys I'll follow some of the other guys from Daily FX as well. Christian Kerr, I have a great respect for the guy. We have a good we've been friends for a while. We were just throwing around some different levels on pound. And from a cyclical standpoint, we're coming in some interesting time. From a tech level standpoint, which is where I kind of jump in, is the pound coming into a major area of resistance. So looking at the pound dollar on the daily, if you guys remember, we've been following this for a couple weeks now. The break initially happened here on the 7th, and when we broke through that median line after failing to move lower, this was a huge area of support, right? This is the formation essentially we've been sitting in all year long. It's the January low, and that's the low that we made in March. So you came into that support, completed a basic 2 equal legs down. If this is going to be a larger scale move, this is the resistance that needs to break. At the same point, might be a nice entry for a short play. So the break above that median line is what shifted us higher. This was the broader bearish invalidation level. Okay, this is a longer term structure that dates back even further. And I've showed you guys this a couple of times. Really strong pivots over the last couple of years into the close of 2014, the open of this year. And once we broke through that, it validated it. Last week, we saw a hold of the major key resistance here at 54.50. The next major key resistance is right here at 55.67. The sliding parallel also dating back to the June low. So you have a daily trigger here. We'll keep that in view. Initial targets on that topside break took you into 55.18, which we noted last night is going to be that 100-day moving average. Beyond that, that 618 is in view in striking distance. Here's what it looks like on the intraday chart. And here's what we look like last night. So 55.15, 55.18, it's the 100-day moving average, keeps moving around, guys. But you get the picture. It was a dead-on confluence with this median line just off the lows. Near-term support on this play, you still have it right here, 54.60, which was resistance and the opening range high. Invalidation, we lift up invalidation, the bullish invalidation level from 53.46, 53.35, which is what we highlighted earlier in the week. We sat there for a while. Turned out to be the best long you could have gotten this week. We'll lift that bullish invalidation level now up to 54, okay? And as long as we stay above that, you want to be cautious on the short exposure. That being said, this is a big area of resistance, huge. You have the 50% retracement. From the advance off the, what is that, the June low. That's the 618 retracement that you looked at on the daily chart off the highs. And you also have to compete with this median line just on the near-term play. So you'll be getting some waning divergence into the open of US trade. Again, depending on what FOMC does, if we see some initial dollar weakness and you spike higher, that fizzles, might be a great opportunity to get back on the short side in the event that the dollar strength story is what carries over. If the dollar keeps the bearish formation that we've been sort of expecting with the dollar index and the euro move, well then if we break this resistance, you could see some serious upside here for the sterling. So we're really there. Mark says, for the one who can't see YouTube content from his or her country, if you use Google Chrome, you can install an extension called ZenMate, which creates a VPN and will make it seem like his connection comes from within the US. Yeah, I don't really know anything about that, Mark. So here's the link. This is for who was having problems. I think it was Cameron, or was it Raj? There's a link for that extension. Thanks, Mark. I appreciate that. As always, man. So any questions? Is this a good short or wait for the trigger break? So Raj, yeah, for me, I don't, I'm not going to front run the data by any means. I have way too, my stops are too tight. My stops are too tight. So this region would be a beautiful short, in my humble opinion, if the prevailing story is going to be dollar strength. Like I said, as opposed to playing dollar strength versus the Aussie, this is something I'd be much more interested in because we're right at resistance for the sterling. What would prompt dollar strength would be either really hawkish commentary out of Yellen, especially if they hold today, guys. Here's one scenario: they hold, they don't move on rates, and Yellen comes out as hawkish as can be. Yeah, guys, we're just basically waiting. All the data is there. We wanted to wait one more month to get the data in, something like that, which would suggest, yeah, that's just, it's just a timing of a month or two here is different. You could see some dollar strength. This would be a nice short in that scenario, Raj. Right? But at a huge juncture here, in my humble opinion, here near term. Any questions on the pound? Okay. Last but not least from last night, euro dollar on this trade, another one that is pretty clear as far as the levels, not so clear as far as the bias. You're basically sitting in a major key range just above the monthly open, 112.08, resistance 113.66, and that's basically what we've been in for the last couple of weeks here. Now, the play is favored to the upside, not only because of the reaction that we got of confluence support yesterday with that rebound, we closed higher on the day. It's the 200-day long-term moving average and lower median line parallel right there. So the fact that we saw such a strong reaction, closed higher in the day, for me, says something about at least near-term momentum. So looking to favor long sides while within this range, but you need to see a break above 1360 to really get the breakout trade. Here's what it looks like intraday. On that front, you have a very clean and very simple weekly opening range just below resistance. And again, that's that 618, 1618, 1367. So the levels are pretty clear. The invalidation level for the long side is going to be the monthly open at 1208. And on a weaker dollar story, this is the play I would prefer, being long side on the euro. Subsequent objectives, you're looking at the April highs, that's 114.35, and then you have a confluence resistance up at 114.70, 114.65. Dan, I would think the opposite. He says, I think the euro pound has been holding the euro down. It's hard to associate it that way. I would say that lack of euro strength is holding euro pound down. Yeah, I mean, we could take a look at the euro pound trade. A lot of people are looking at. Here's what it looks like, guys. From my part, well, first of all, any questions on the euro? Broadly favoring the long side. The levels are mapped out on the report. But again, if you need to take a snapshot, go ahead and do that. And where would you look for a stop if euro dollar goes long, says Eileen. Great question. And I can't give you that answer until we see what price action develops to. So Eileen, let's say you saw a pullback. The initial surge was dollar strength. Euro drops, right? Right into the support level. The stop would be right against the weekly opening range low, i.e. the monthly opening range low, or the monthly open rather. So the stop would be just below 111.12. It'd be like 111.95 for me. If we drop into support and we get a long trigger, that's where my stop would be. If it breaks out to the upside, I can't tell you where the stop would be because I need a pullback and then a trigger to go long against that low. So you might break through the highs, run into 14.35. I'd miss that entire move because I'm not going to chase. And when it pulls back, once we get a trigger again, we take the long against this former resistance, now support. And we look to play that extension up into 14.65. So it really depends what the near-term picture does. Does that make sense, Eileen? Great question. Very relevant for where we are right now. Yes, makes sense, and glad for the detailed answer. You're more than welcome. Always have great questions. Oops. This is just the 200-day moving average. So we'll definitely be watching for a breakout of this range on the data print, and longs are favored above the monthly open. So those are the four setups that will, that are going to be highlighted on today's basic FOMC print. Just a quick reminder and a quick disclaimer, guys, we're not trading all four of these. Don't try to. It's going to make a mess of things. What you want to do is sort of have all four charts out. You want to be watching for what the data does on the initial print. We'll have a bias right from there. If they raise rates, we'll look to fade a more broader dollar rally. If they don't cut, that's, I think, what it'll be the consensus. It's going to be a little bit harder to call. We'll have to wait for the presser. But either way, most of the volatility sometimes will come at the presser. So you want to make sure that you're staying nimble into 230 when that starts. And once we get that initial bias, then you want to focus on which one of these pairs we're going to want to operate on. Don't try to get involved in all four. You won't be able to, manage all four of those with the volatility we're expecting today. Really quick, before we jump into your questions, I see some great pairs I do want to cover. Excuse me, the dollar yen. Quick reference for where that is. We're trying to push through resistance again. I'm not buying it. I see if we can. Oh, it's right there. We're pushing through the 200-day moving average. This is the near-term bearish invalidation level, but you have resistance into 121.21, and that's the monthly open. So on this scenario, on dollar weakness, if we do see a surge against the high that we made for the month, might again be a nice opportunity to short the dollar yen. If you recall, guys, for the last 4 weeks almost, dollar yen's been highlighted every day on the intraday chart update. We just broke through the monthly opening or the weekly opening range high yesterday, and we're not looking for short triggers necessarily from here. On a dollar weaker story, I love shorting dollar yen, but at this point, now that we're pushing through that 121.80 level, I'd be hesitant to touch this thing. Typically a very strong reactor to dollar basis. Dan, my man. It's been a while since I heard that. He says, on the abomination, trying to suck people in, LOL. Excuse me. That's funny. If you guys followed me on Daily Effects, we called this the abomination for years, because it does sucker people in for sure. So we'll wait for some clarity on it. It gave us some beautiful scalps over the last 3 weeks. I'm willing to sit that out. I'm not willing to, throw away those profits to try to short this thing. At this point, you're heading into a major event risk with a pair that typically sees very strong reaction. We need the break below 119.88, which is actually the 2015 open, to really validate a downside break of this formation. And again, at its face value, we're just in consolidation, right? So those levels are highlighted on the radar charts from last night. The last one from last night's radar charts was Kiwi dollar. And this is another one where the monthly opening range is in focus. Not the weekly opening range, but the monthly opening range. We talked about this briefly yesterday as well in the webinar. You're coming into resistance, or the monthly opening range is just below resistance at 64.13 or so. It's a 618 key retracement longer term. And another play I'd be interested in on a weaker dollar story. So a Kiwi dollar breakout to the upside. And that would take a move surpassing 64.13. Would put us on a nice, real constructive path. Dollar strength, if the resistance holds, or if you see a spike that allows us to take a stop against that for some short scalps, that might play out. Here's what the intraday chart looks like. Jamie's still holding that long from last week, which we pinpointed. Really, really nice. It was like a basic 10 pip stop. Long story short, we're still within the confines of this formation. As long as that holds, you basically need to see a break of the weekly opening range low to get back on the short side. So, I'd rather play a weaker dollar story here if dollar sells off with a breakout looking to buy pullbacks than necessarily try to play the short into support, because it's still constructive here. It's still constructive. Also keep in mind that since the start of the week, 40, 60, 40, 60, 40, 60, right? No conviction from a momentum standpoint. But the levels are pretty clear. All right, and those are the setups that are all ready to go for today's FOMC interest rate decision. Those are all the dollar crosses that we'll be watching. And it's going to be a big print, guys. So patience pays. It's going to be a release where the initial release, if they do hold rates, it's going to be all about what she says. It's going to be all about the dot plots. We'll try to keep you updated on SB Squawk as much as possible with those developments. All right, through your questions. If the dollar, Michael Greer, Michael Greer, great to see you in the room. He says, if the dollar is weak, I want to be looking for Euro and Aussie. If the dollar is strong, I want to be looking for dollar yen and short sterling dollar. Short sterling dollar would probably be my favorite play on a strong dollar. Weaker dollar, euro, and yeah, I'd have to agree with those. Aussie, I'd want to see the topside break, Mike. But yeah, looks good. Looks good. Okay, so I'm going to take your questions in the order that they came here. Raj wants to take a look at sterling Aus. Sure. I haven't looked at that in a couple of days. What's it doing here? Oh yeah, we did go over this briefly earlier in the week. So that support held, Raj, which was 214.20 into 215.27, which is the high again from July, the opening range high from August, and the open essentially for this month. It also has a 618 extension from the decline, or from the decline, right? So in fact, you're seeing a nice rebound through that level. By my estimates, near term, you're at near-term resistance. Let me see what this looks like on the intraday chart. Sterling Aus. Yeah, so that former trendline support is sort of being used as resistance. Oh, it looks like we're breaking through 618. Okay, let me update these levels for you real quick, Raj. what we'll want to do at this point that we've made a concrete rebound off that low is just take a basic retracement. That 100% extension caught the lows almost to the pip. This 618 is not really necessary. This whole retracement's no longer necessary. And those are the levels I'd be like sort of looking at near term. All right, so it looks like we're making a break out of this near-term structure just off of the decline from last week's high. That puts you at risk for a little bit more of a substantiated rally towards 217.30. I would put bearish invalidation right here for the decline for the week at least. So you have the weekly opening range high, which comes in just higher. But if this formation is going to hold, you have a confluence with the 618 retracement just off the highs. And that basically gives you like 218.17. So this is going to be the major resistance. If we break through that, I really wouldn't be looking to short this thing. I'm not sure if you're on this trade, Raj, already, but those are the resistance levels I look for. Let's see if there's any triggers here. Yeah, that looks pretty good. But you're right in the middle of the weekly range, so I wouldn't necessarily have a play for you from here. You look for a rally and short triggers up near 218.16, or in any case, if you pull back towards 215.30, you might actually get another good long trigger. But it does look like from the initial price action here that you want to sort of maintain in your term, at least the immediate bias is still weighted to the upside. Raj, does that help? Make sense on Sterling Oz? Interesting look. Not necessarily something I'll be stressing today, but coming into an interesting level here. Okay. Moving through more of your questions. Dan, I got you. Raj. Okay. Hey, Dan, I think I missed your question there on dollar CAD. He's saying dollar CAD 130.60 is a big level for dollar CAD. That is the monthly breakout level, correct? 130.60. It is, right, that we made here, but it's also just a basic 236 off the high. It says a break below there would expect a challenge of 128.30. Ahead of 128.30, there's a couple of things ahead of 128.30. I do know what you're talking about, 128.30. You're basically looking at that high from March, right? Objectively, that would make sense. Just ahead of that, though, I'd be looking at a couple of different things. Let me just make sure trend lines are snapped. I'd be looking for this former upper median line parallel. I know we sailed through it multiple times early in the year, but if you look back, it's been pretty clean. Okay, that slope has defined a lot in the pair. So that upper median line parallel comes in just ahead of that target, and so does a simple 38.2 and the low swing from July. So if we see a break below 30.60 on this, Dan, I'd be looking for like 129.40, 128.80, and then that high that you're looking at is probably be the next target. So a couple levels just to keep in mind ahead of that 28.30, but I'm with you on the breakdown. For sure, that's a pretty big region of support. You also have the median line off the highs just below it. So give yourself some wiggle room here, but broadly speaking, the breakdown levels are pretty clear. Mike Greer says, would you go long dollar CAD if the dollar shows strength? Look, guys, we need to know where to pick and choose our battles. So, Mike, I'm not telling you don't go long dollar CAD if the dollar shows strength. It could be a great scalp. I just would have a preference from positioning wise of where I would want to be. On the broader trade for dollar CAD, we've been talking about the possibility of a dollar CAD breakdown. There's momentum into the highs. You got a multi-month trigger consolidation break. And even if we take a long, eventually you would come into some resistance where I'd be looking to short it, right? Mike, the long for this is validated with a breakthrough the monthly or the reversal day close and the high day close. That's what put me constructive, right? And there's clear targets to the upside, i.e. this 34.57, which is a big, big level. So I would rather scalp the pair where the initial reaction or the play that I'm going with is with the broader trend I'm expecting. So dollar CAD, I'm looking for it weaker, right? So that's dollar weakness. So on dollar strength, it would probably be in my best interest to look at a pair where I'm already expecting that. We've been favoring the euro long, right? Does that make sense, Mike? I'm not saying don't do it. It could show a great rally. It could take you right back into 33 with a really nice play. But I still would probably be more comfortable in a pair where the broader structure, the broader trade I'm looking at shows dollar strength. He says if it makes sense. All right, cool. It's just a different mentality of the way you're approaching, and the only thing it's helping you do is narrow down what pair I want to look at. I don't want to just be concrete solid on one pair and try to play on both sides. No, there's different scenarios. That's going to make me look at different, that makes me look at different pairs. And certainly whether the dollar reacts with strength today or weakness is going to sort of steer me on the right path for that. Good question from Michael. Hope that helps. Dan, hope that helped on the dollar CAD levels as well. Hamid wants to look at, hi, can we please take a quick look at sterling CAD? Sure. Sterling CAD. What's she doing these days? Okay. Well, let me just... Okay. Objectively, you're basically just testing the opening range high for the week here. This needs to be readjusted. It's the high day close. Okay, that was the high day close from last month. The high day close is not there anymore, so we don't need this. 2%. Oh, it's a real nice slope. Real nice slope. So this is what I would say. You're testing resistance right now at a basic 38, basic 50% off the highs. More critical resistance is just higher at 205.60. Got a nice confluence region there into the close of U.S. trade today. And then you have 206, which is a basic 618 rather. It's a big range, but it's also a big range scalp. So I would actually highlight this whole region right here as near-term resistance for Sterling Oz or Sterling CAD. It kind of pans out pretty nicely, actually, now that I look at it with the expectations we have for the pound. So if the pound Hamid pushes just a little bit higher into that key resistance, you might see this pop higher, and then you start to see CAD strength, dollar weakness would be great, and then that dollar CAD would really show some downside, and that would coincide really nice with the reversal here in Sterling CAD. So trying to put the puzzle together, it actually looked pretty good, but I'd be looking for resistance up in this region, a breakout beyond that. You have a really nice clear-cut target here into 207.60, 207.50. Near term, even the momentum signature looks like it's turned bullish here. Near term, bullish invalidation, I would put, hold on. Yeah, I wouldn't be able to pinpoint a level on this for you. I would say bullish invalidation is going to be with that lower median line parallel. As long as you stay above that, I would look to stay constructive. I mean, look how many times we've tagged this slope. Real super clean, right? On the upswing, resistance. So you might see a downswing to the downside. This would be a nice long position and i.e. bullish invalidation. But the immediate risk is still for a stretch higher here near term into that resistance level. Hamid, does that help on Sterling CAD? I think Jamie's right on with Sterling CAD, short at 206. 206 to 618 looks like the play. So for near term, yeah, for sure. That's the level we just highlighted. Yep. It's funny because most of the times we even discuss trades, the levels that we throw at each other are exactly the same. But from a near-term prospect, that's the rally here is still going to be the focus as you head into the event risk, which should be rather limited for this pair. But a stretch higher definitely is on the cards, and then a pullback at least into this support would be the first sort of play I'd be looking for. But this would be the bullish invalidation level. So a break below that, you'd think you'd get a lot more pullback here for for Sterling CAD. Hammond says, yes, thanks. More than welcome, sir. Always good to see you in the room. All right. So, guys, did we look at Euro Pound? Dan wanted to look at Euro Pounds, and there was another question on Cameron wants to look at Sterling Yen. Let's just go through it real quick. Don't remember if we covered it, but here's what Euro Pound looks like on the intraday. The 200-day moving average confluence with the median line off the highs, the exact pinpoint almost was what capped the advance, and we saw a little bit of a pullback here. For me, this is still the invalidation level. We need to get through this to shift higher. Looking at the intraday chart, I think I like it a lot better on the intraday than I do on the longer term. But real clean weekly opening range here in play, just above key support. We probed below this a couple of times, but it's a 618 from the initial drop that we saw after that rally hit that median line. And it's also a 618 from the advance off the lows. Or excuse me, this is a longer dated 618 from the decline off the highs that we made in May. So you can see just sort of stuck between a rock and a hard place here, at least from a near-term prospect on Euro Pound. I think Jamie's got a better grasp on this cross than I do at this point. Sterling Yen, same thing on that. We talked about that yesterday. I'm not really thrilled with it. The breakout did come in some resistance, and it's a 50% retracement. The major key resistance, sort of the dream short, or the craziest breakout we'll see, would be right here at 89.56 into 89.70. That's the December high. Real nice pivot in price. The upper median line parallel, the former lower median line parallel, the formation that took us off the lows. Real nice region. And in fact, now that we've made a break of that high, let me just tack on that quick extension, see what it looks like. All right, so maybe offering some near-term levels here, 188.50. Again, the median line confluences from that region. And even a basic trendline support, channel resistance. Wow. Really highlights that region. I think the risk is for a move higher here in sterling yen. A little bit of a split decision because of where we are both on the respective trades for sterling dollar and dollar yen, but it looks to me like this was an initial opening range break that we made yesterday of the weekly opening range high that would keep the upside focus in play. The momentum signature, which was initially bearish to start the week, you can saw the formation off last week's high, and also the 60 holds here in momentum, 40 break, 60 hold, kept the downside bias in play. This trade now looks like it's shifted the focus near term to the upside. You're at resistance, could get a pullback into that median line, but broadly speaking, you stay constructive above the highs. And again, guys, I'm just doing this off the fly. I really haven't been following this trade, but just for your consideration, Cameron, I'd be looking at a constructive bias here. Whoops. I'd look for a constructive bias above that region. You're at resistance right now, so expect some pullback, getting some divergence. So I wouldn't necessarily want to play the short, but if you get a pullback into this region, look for some long triggers, and that would be the near-term bullish invalidation. Cameron, does that help? An emphatic yes. All right, awesome. Thanks, he says. Hey, you're more than welcome. Hamid says, what are the best moving average settings? You know, I'm not a big fan of moving average, Hamid. Let me just tell you, I watch on the dailies, I will watch the 200 and 100. On the weeklies, I will watch the quarterly and the 52-week moving average. So a 13-week and a 15-week is typically what I'll be watching on the weekly charts. And on the daily, like I said, a 200 and 100. And that's just because, you know, in classic technical analysis, and even guys that follow stocks, these are, you know, sort of a standard tool that everyone will look at. So a lot of times the market will just gravitate towards them, and you'll see some really nice plays, either a breakout or a nice tag. Using crossovers or moving averages as a strategy for trade, and personally, I'm not really a fan of. The signal is very delayed, especially if you're looking for a crossover strategy. You know, everyone talks about the death cross or the golden cross. You know, these things are notoriously delayed. So yeah, they may work, but for our uses here, the near term, you know, they tend to be a little bit more of a delayed signal that might offer or prompt some delayed reaction. So I'm not a big fan of them. On the near-term charts, though, sometimes a 10 moving average or a 20 moving average will offer some guidance as to what the momentum is doing, but not so much a fan of heavy use of moving averages. Aline says, is it feasible in your evening strategy updates to start noting where to look for possible stops if the move does this or if the move does that? Or would that be confusing with too many options? Guys, it's up to you, Eileen. I mean, it's up to you guys. If I get enough feedback and that's something you guys want to see, please. I always encourage you guys, info@sbtradedesk.com. You know, feel free to send us any and all feedback. We take everything into consideration. By the way, IDO should be good and ready, like I said, by the end of next week. So I'm looking forward to that as well. But yeah, for sure, Eileen, I mean, if it's something that everyone thinks will be helpful, you guys let me know. Please feel free to drop some messages here in the board or shoot an email over. The only thing I don't want to do with that, Eileen, is I don't want to set an expectation where it confuses the bias. If you know, all of them will have a bias, a bullish or a bearish invalidation level. So you know the direction I'm looking for. You know, if there's a bearish invalidation level, guys, that means I'm looking to sell rallies. If there's a bullish invalidation, means I'm looking to buy dips, right? So I'd rather, you know, not give you the, if it breaks here, look to buy the pullback into here. If it breaks down here, look to buy this. I'd rather highlight those levels and give you the bias, right? Maybe just note the stops for the initial bias. Yeah, that's definitely something we can do. Cameron says, I agree. Awesome. I mean, the more feedback you guys give me, the more, you know, pertinent I can make the reports for you. And that's all that matters at the end of the day. So, Eileen, appreciate that a lot. Cameron, same with you guys. Feel free. All right, so that's sterling yen. We went over sterling CAD. All right, so I think I've made it through all of your questions. We are obviously over on time as usual, but It's an important day, so I'm glad I was able to get that out. Again, a quick reference just before we go on all the dollar crosses. We head into the U.S. Open. You're not likely to see that U.S. opening range break. It'll give you something much today just because of what's on tap. But Dan says, awesome job as always, Michael. Thanks. Oh, I appreciate that, man, as always. Euro dollar levels unchanged. Dollar yen, as we start the session, still holding just above the opening range high. Sterling dollar, see if we can get that stretch into 55.67, 55.50. And the dollar CAD, I think a lot of people are going to be looking at this today because there's sort of this sort of disbelief that the dollar CAD could never pull back. And that's why the more people tell me they want to buy this pullback, the more I get a little bit more excited at the possibility of a move beyond the monthly opening level there at 31.38, and the levels would be pretty clear on the downside. So best of luck trading today, guys. Stay nimble, watch your leverage, and I will be out for a wedding this weekend, so there might be a delay in the Sunday print, guys, as far as that. Best man duty, so I have a lot to take care of after today's fun. So there won't be any updates till then, but the swing updates will be on tap. No change on that front. Again, best of luck trading, guys, and I will see you early next week on Daily FX at 8:30 Eastern for the Daily FX Scalp webinar, and then obviously here on SB Trade Desk Tuesday, Wednesdays, and Thursdays. Cheers, guys. Best of luck trading today.